in a mature market like the US, there's limited scope of active fund management. It becomes very difficult to generate the kind of alpha that would actually justify paying a fee. What kind of role do you think active management, has to offer in a developed, mature market like the US, where so much of money is flowing into the ETFs and trackers?
The growth in our industry from a product standpoint has been in the ETFs. It's been in the passive space, and there's been a decline actually in investment in active management. And I think much of that is positive, because the trackers, the ETFs, the passive ETFs have been wonderful lower cost ways for investors to get access to the efficient spaces in the market, the well-researched, overly researched companies where it's much harder to add value with active management. The classic example of that is the S&P 500, right? The largest 500 companies in the market. Great, mostly profitable companies. They're extremely well researched by Wall Street researchers, other institutional investors, consultants, etc. Hard to add value there. So you're hard pressed to steer an investor into a higher fee, actively managed product in that space where the markets are so efficient. So to your question, it's where are the inefficiencies still in the capital markets for a smart investor, portfolio manager to add value. Certainly in the private markets, private equity, private credit, and we're seeing continued use of that. It's entered into the retail space. I'm not sure if that's a good or bad idea, because with the private markets, while you get access to some interesting emerging companies and asset classes, there's very little transparency. Liquidity is challenged. So that's very much you got to do your homework, buyer beware type of market. There isn't a lot of public information, but that certainly is where there are inefficiencies in the market. In the public markets, where there is still plenty of liquidity and transparency, but inefficiency, I would say, you mentioned small cap companies or small US companies, small companies outside the US as well, but I'll focus on US small companies. Very much under-researched. And the reasoning for that is how Wall Street research firms, the big financial institutions, make money in the capital markets. And they make money on volume, massive volume. So an extreme example would be the Magnificent Seven, right? Those primarily tech companies that we hear about. Combined market cap now of north of $25 trillion. Companies that everyone talks about, everyone researches, their every move. That's a very efficient space, right? Hard to add a lot of value there with active management. Although some large company portfolio managers can add value in that space. That is the classic market for the trackers. In the small cap space, because the volume isn't there, still some liquid companies, but instead of trillions of dollars, you're talking about mere billions. I'm not talking about stocks. But companies, still strong market capitalization, balance sheets, earners, but they don't have the same research coverage because they don't generate, frankly, as much revenue for the big Wall Street research firms. So an active manager who really digs into the best earners with the best prospects for continued growth. These are the innovators in the US economy, these smaller companies. They're the developers of new product. They're the picks and shovel of the AI space. They're doing a lot of the work in the AI space for the larger companies. They're not well covered, and they create a significant opportunity for an active manager to deliver meaningful returns over what you could just get in the passive space. Now, I would say it's not an either or. It's not small companies or large companies. It's both, right? And I'm sure in the kinds of portfolios that you advise investors with, you've got plenty of balance in the portfolio. So you're going to use a mix of trackers for the very efficient spaces, and then you're going to look to active managers who can really add value in the inefficient spaces, like smaller companies. So we continue to have a bias towards smaller companies. But again, I would emphasize that's more of what we would call a satellite type exposure. You're going to have a
Absolutely.
much smaller percentage of your assets. The bulk of your investment portfolio in equities is going to be still geared towards those large companies that we see, in the S&P 500 type approach. But yeah, still inefficiencies where you can find them with good portfolio managers who are willing to do the work.
Sure. And if I understand you correctly, you could be negative on the small cap index, but you could still curate a 50 stock high quality portfolio, which are under researched, without compromising on liquidity, and generate sizable alpha. I mean, that's what you have been doing. I mean, it's fantastic.
I think that's true for just about any asset class. There's always, every so often when we see market volatility, the baby gets thrown out with the bathwater, right? That's the classic expression. But there's a lot of good babies in that bathwater that over time, based on, good companies with good products, with good management and good earnings and good guidance on earnings over time can really help an investor outperform the market and do well. You just need good managers who are patient and are willing to do the work to pick those babies out of the bathwater. And I'll leave that analogy because it's not necessarily a great one, but that's what a good active manager does.